while headlines trumpet record S&P 500 highs. A subtle, often overlooked signal from corporate balance sheets is flashing red. Are we truly experiencing robust growth, or are companies skillfully masking underlying vulnerabilities? Many corporations have become masters of adjusted earnings, often excluding one-time costs or non-recurring items. While legal, this can inflate perceived profitability, making a 5% actual growth appear as a robust 15% to an unsuspecting investor. This illusion can be devastating for your 401k. You invest, expecting genuine returns, only to realize later your retirement nest egg was built on a house of cards. The feeling of being misled can erode years of trust and savings. This is the find-out phase. It's when the market's veneer cracks, revealing the true economic landscape. Think 2008, when the housing bubble burst, or the dot-com crash of 2000. History tells us these moments are inevitable. One key signal often overlooked: ballooning inventories. When companies accumulate unsold goods, it suggests slowing demand. Target, for example, saw its inventory to sales ratio jump over 15% in Q2 2022, forcing heavy discounts and margin compression. Another critical indicator: shrinking profit margins. Rising costs for labor, materials, and interest rates directly squeeze a company's profitability. If a firm's gross margin drops from 40% to 30% without a clear strategy, it's a red flag for future earnings. Consumer spending, which drives nearly 70% of the U.S. retail sales data, shows a deceleration, and the University of Michigan Consumer Sentiment Index remains stubbornly low at 69. One as of May 2024. This directly impacts corporate revenue. Household credit card debt surpassed $1. $13 trillion in Q1 2024, an all-time high. With personal savings rates hovering around 6%, consumers are increasingly relying on debt, signaling future financial strain and reduced discretionary spending. Even the resilient tech sector isn't immune. After a boom, we've seen significant layoffs at companies like Google, Amazon, and Microsoft, totaling over 200,000 tech jobs cut since early 2022. This indicates a contraction in an area once seen as untouchable. The S&P 500's performance often feels disconnected from these realities. While the index may soar, driven by a few mega-cap tech stocks, the broader market and underlying economic health could be deteriorating. This divergence creates a dangerous illusion of prosperity. While retail investors chase headlines, smart money often moves quietly. In Q1 2024, insider selling ratios reached their highest in 2 years. This suggests that those with the most intimate knowledge of companies are de-risking, not buying the dips. In 2023, S&P 500 companies spent over $790 billion on buybacks. While this props up stock prices, it doesn't reflect genuine operational strength. Another trick: maintaining dividends by taking on more debt. When a company's dividend payout ratio exceeds its free cash flow, it often means they're borrowing to pay shareholders. This is unsustainable and a major red flag for long-term health. So, how safe is your 401k or investment portfolio when these hidden signals are ignored? Many Americans blindly trust the market, but critical decisions should be based on transparent data, not just optimistic narratives from corporate press releases. Don't be caught off guard. The market rewards skepticism and diligence. Understanding these secret signals empowers you to make informed decisions, protecting your wealth from the next inevitable find-out moment. While vigilance is key, what exactly are we vigilant about? It's often the illusion of reported earnings. Many companies master looking good on paper with soaring revenue, but true value is in the quality of those numbers, not just the quantity. Companies with impressive revenue growth often had negative free cash flow, burning through capital. Investors learned a harsh lesson: cash flow, not just reported earnings, is the lifeblood of a sustainable business. Another red flag: excessive debt. While leverage can amplify returns, it also amplifies risk. During economic downturns, companies saddled with high debt-to-equity ratios, say above 2.0, often face liquidity crises, leading to sharp stock price drops or even bankruptcy. This brings us to valuation discipline. Legendary investor Benjamin Graham taught us to distinguish between price and value. A company might be excellent, but if its stock is trading at 50x earnings in a 20x market, you're paying a premium that offers little margin of safety. Many Silicon Valley tech workers, heavily invested in their company's stock options, learned this the hard way. Diversification isn't just owning different stocks. It's spreading risk across sectors, geographies, and even asset classes like real estate or bonds. This strategy hinges on the power of compounding. Warren Buffett famously said, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." Even a modest 7% annual return on $10,000 becomes $76,000 in 30 years. Yet our own psychology often sabotages this. Behavioral biases like loss aversion make us sell winners too early and hold on to losers too long. Fear and greed are powerful forces on Wall Street, causing irrational decisions in moments of market volatility. Understanding that market cycles are inevitable boom and bust is crucial. The S&P 500 has experienced 13 bear markets since 1929, with an average decline of 35%. Yet, every single one was followed by a recovery, demonstrating the market's resilience. This leads to focusing on risk-adjusted returns, not just raw gains. A day trader might boast a 50% return, but if they risked 90% of their capital, that's not sustainable. Metrics like the Sharpe ratio help you compare investments based on return per unit of risk taken. Warren Buffett also champions economic moats, sustainable competitive advantages that protect a company's long-term earnings and market share. Think of brands like Apple or Coca-Cola with their strong brand loyalty, or companies with patented technology. Beyond identifying moats, observe how companies allocate capital. Are they reinvesting wisely in growth, paying down debt, or buying back shares at attractive valuations? Poor capital allocation, like overpaying for acquisitions, can destroy shareholder value over time. And remember, macroeconomics always plays a role. Interest rate hikes, inflation, or GDP growth forecasts from the Federal Reserve significantly impact market sentiment and corporate profitability. Ignoring these broader trends is like navigating a ship without understanding the ocean currents. The market is a dynamic beast. Continuous learning isn't optional, it's essential. Regularly reading financial news from sources like the Wall Street Journal, analyzing company reports, and adapting your strategy based on new information is how you stay ahead. Ultimately, your investment journey needs clear financial goals. Are you saving for retirement with a 401k, a down payment for a home, or building generational wealth? Defined objectives help you choose appropriate strategies and stay disciplined amidst market noise. The find-out phase is inevitable for every market cycle and every company. But with the right mindset, a data-driven approach, and unwavering discipline, you can navigate these challenges, turn uncertainty into opportunity, and secure your financial future. Stay educated, stay strategic, stay ahead.